Hello guys, you're welcome back to another episode on our past question discussion from University of Professional Studies located in Accra, Ghana. So hey, if you're new on this channel, kindly make sure to subscribe, smash the like button, and then share with your friends as well. If you're a returning subscriber, thanks for joining us once again. We are grateful to having you here. So today we are taking on to another question altogether, and then it is on return, risk, and portfolio management. You are welcome once again. So as you can see on your screen, there's a question that we are looking at in today's video. So let's get started with it. So I read, suppose financial analysts believe that there are four equally likely states of economy: depression, recession, normal, and boom. The returns on Allo's incorporation are expected to follow the economy closely. The return predictions are as follows. We have the state of the economy, and then we have what? The returns that Allo incorporation is expected to obtain from these investment opportunities. Now let's continue. You are required to calculate the expected returns, that's II the variance, and then II the standard deviation. And there's also another question here, that's question B. As part of question 1, suppose you invest 60% of your portfolio in Exxon Mobil and 40% in Coca-Cola. The expected dollar return on Exxon Mobil stock is 10% and on Coca-Cola is 15%. The standard deviation of their annualized daily returns are 18.2% and 27.3% respectively. Assume a correlation of 1.0. You are required to calculate I, the portfolio expected returns, the portfolio variance, and the portfolio standard deviation. So you realize that with question A, it is just a single word investment. Just a single investment that as an investor you are investing in, right? And as an investor, at any time you're making an investment, these things are very crucial. The risk, the return, and how you manage this investment is very crucial when it comes to what? Investment, right? Risk, you are talking about what? The likelihood that whatever you invest may be greater or lesser. The likelihood that whatever you investment, you're gonna receive it or you may not receive it. So risk is more like on probability. Is that okay? And the returns, we are talking about what you earned in an investment, what you earned, the future returns, something going to earn from investment or from investing. So the returns, the amount that you earned from investment, what we call your returns. And management, how you put in effort and strategies to ensure that your investment will yield a good returns, and then have a reduced risk is what management comes in. So in that we're talking about portfolio manage. So the question 1B here is actually a blended of two investment opportunity here. That's Exxon Mobil and then Coca-Cola. So this is a portfolio investment, right? And then this is a single, the A is just a single investment that you are making. And remember, with the A, they made us aware that return predictions are as follows. So when it comes to investment, you want to invest. When it comes to investment, and you want to have a fair knowledge of the investment you are making, the risk factor, the returns, and how the management goes. Yeah, we have two data approach that you can use as an investor. You can use either the expected returns or the historical expected return. Talking about future data that's yet likely to, or that's yet to occur, in that you make predictions. You use probabilities to make projections of the expected returns, risk factor associated, and then the management of these investment opportunities. But then when it comes to historical, you use past data to make to use past data to use as a calculation. You make calculations based on this past data and to know the risk, the returns, and then the management associated with the investment you want to undertake. So that is the two sides of the coin, either you use historical data, that's past data, or expected data, or future what data, in the use what probabilities, right? So that is, and so in this question you can clearly see that it is expected what data. But here is the case that we weren't given any what probability. So the idea is that once we weren't given any probability, we are expected, or in that we can say that the probability for each state here should be what 1. Probability of each state here, that's depression, recession, normal, and boom, should be what 1. So that is something that we need to know when it comes to risk, return, and their management. So now let's start. So because the probability wasn't given in a question, I'm going to create a table for probability as part of this. So I'm going to create a table here. Sorry for that. So it's going to be the table for my probability. My probability values. Probability for, so far it wasn't given, so the idea is that it should be what probability of what 1. I hope that is clear from the state of the economy with regards to, or this expected what data that we are using to calculate our expected returns, variance, and then standard deviation. So our first requirement, you are required to calculate what expected returns. So expected returns, talking about future returns going to end on the investment in this what economy. Is that okay? So let's use this space to represent as our board for the workings in this case. So the expected returns, call it as what R bar, right? This is a formula for expected returns when you're using expected data or future data in analyzing the risk, return, and then its management. It's going to be N sigma with your I, which is equal to 1, with your probability values multiplying what the returns from individual different, the returns from n different outcomes or individual what state of the economy are going to end as a return. So there's a formula that we are having here. So here our expected return based on this formula is going to be, so we know the R is the return, so return on what? A. That's return on the state of the economy, and what we are going to earn. So because this is expected, so what you're going to earn from this state of what economy as a return, take into account the risk factor that we are yet to know. So here, let's see. I know the probability for depression is what 1, so it's going to be 1 multiplying. So it is what negative 20%, so it's going to be negative 0.2. We can convert it to decimal. Is that okay? Plus, so because you see this summation symbol here, meaning that we are multiplying the probability and then the returns, and then once we multiply each state of the economy and its probability, and then we sum them up. So that's why I've introduced the addition sign here. So that is the first depression. I hope that is clear. Then the next one is 1 multiplying 0.1 as the recession. I hope that is clear. Then it continues, goes on the normal, which is what? So 1 multiplying, and I know the reason why I hope you know the reason why we are using the 1, because the probability wasn't given. So we are sure that the probability is going to be what? 1 for this, because the price wasn't given. The idea is that it should be what? 1 for all these state of economies and the returns in that case. So let's take note of that. And then the boom is also going to be plus 1 to bracket 0.5, and this is how we calculate expected return for using future data or expected what data, right? So with that, per my calculator, I had 0.7 as my expected returns from this state of the economy. If you like, let's try with the calculator. Remember, any number multiplied by anything times what? 1. So here it's gonna be 0.2 plus 0. What was the second one? plus 0.1 plus 0.3 is plus 0.4. So plus 0.1 plus 0.3 plus 0.5. So then I get something like this, 0.7 as a decimal. So let's take note of that. So 0.7, or can write as, let's say, 70%. 70%, and you are good to go. So that is the expected return. So this is what you're going to end as a return when you invest in this state of the economy. The overall return, the average from this state of depression, recession, and normal. So let's see the risk, whether the risk going to match with the return going to end. So let's see. So we are asked to calculate what the variance in finance, or variance. I'm talking about the variability of what, the variability of what data set, how a set of data varies, or how far a set of data from its what mean. In this case, going to be the return, the expected return. That's going to be the mean return for this investment. How far or close a set of data is to its mean. In this case, the mean return in that case. But then, when it comes to variance also help us to analyze the degree of what the risk factor associated with what an investment, but doesn't give a clear picture, since it cannot tell exact risk that you're going to what actually let's say actually incur in the future, or the expected returns you're going to also earn in the future. But then the one that give a clear picture about the risk factor associated with investment is what we call standard deviation. So actually, variance actually help us know the degree of the risk associated with the investment, but it doesn't give us a good picture of the riskiness of what that investment. But then the one that gives a good picture of the riskiness of an investment, or the risk factor associated with an investment, is mostly called the standard deviation, because of the volatility associated with what the risk. Variance cannot give a good picture of it, but then standard deviation can help us give a better picture of it. I hope that is clear. So please, if you're really enjoying this video, please make sure to smash the like button. It's very important. Please smash the like button of this video, okay? If you haven't subscribed to the channel. So by this way, once we release out any video or any update, you'll be the first person to get notified. Share with your friends as well, and a comment, let me see whether you're getting things right or not, so that I can know how to assist you far more better. So let's continue. So we are asked to calculate what? Variance. So variance is written as what? As the symbol with a square. So with variance, this is how we calculate variance for expected what? Data. So it's always your n with your summation symbol with your I here, which is equal to what? 1. Okay. And we have your probability for various what? Outcomes, multiplying your returns from different what? In this case, different state of the economy, right? Minus your mean return. Then you square it. So this is how we calculate for the expected. We calculate for variance using expected data, data of future data. So this is the formula: the probability multiplying into bracket the returns from different state of the economy. In this case, here 20%, 10%, 30%, and 50%, and then subtract your mean return from these returns and square it. So that's how we calculate. So please keep this formula. It's very important you have these formulas on your fingertips. So once you're asked to calculate, so that we can quote it and then work along in that case. So here, let's go. So here we know that since the probability wasn't given, we have written as what? 1, 1, 1, 4. Instead of the economy, we're going to follow the same rule. So it's going to be, so it's going to be 1, right? Multiplying. So let's see. The first return on allow incorporation is negative for 20. So it's going to be negative 2, 0.2, sorry, minus, I know my return was 0.7, so minus 0.7, then you squared it. I hope that's clear. Plus, remember it's summation, so we are summing them up. We're going to add the multiplication of the probability and the difference between the different outcomes as a return compared with the mean return and squared it. So you're going to sum them up in that light. So you do same for here. So 1, and then you come to recession. 0.1 minus 0.7, then you squared it, plus, and then we come to normal. That one too is 1, 0.03 minus 0.7, hope that is clear, plus 1, and go for boom 0.5 minus 0.7 in that case. So at the end of the day, remember, any number multiplied by 1 is what the same thing as for the number exception of 0. So here I can say that here is what negative 0.9 all squared, plus here is going to give us negative 0.6 squared, plus here going to give us, I didn't square this, so I need to square, give us negative 0.4 all squared, plus then going to give us negative 0.2 all squared. So with the calculator, you should be able to arrive at something like 1.37 as your variance for this word investment. So in this case, let's use the calculator to compute this. You have negative 0.9, negative 0.6, negative 0.4, and then negative 0.2. So let's see with your calculator here. Let's see something here. So once you have this here on your calculator, let's conclude this. Then this one squared, you're gonna get what? 1.37 in decimal, as you can see on the screen here. So that becomes your variance for this investment from different state of the economy. I hope that is clear. All right, so this is 1.437, and as I've said earlier on, variance doesn't give a clear picture of how risk an investment is, right? Because of the volatility of the data. Because variance, we are talking about the variability of our data and how the data are actually farther away or closer towards its mean. Here in this case, expected what? The mean return. That's the expected return or the mean return in this case. So the one that will give us a clear picture. The reason is that the variance doesn't give us how future risk and the return of a particular investment can be easily estimated, right? But then standard deviation will give us exact, and will tell us what risk associated with this form of investment and the return is going towards end. Is that okay? So though variance measures the degree of an investment, but it doesn't give a clear picture. But then standard deviation actually measures the risk associated with investment, but they also give what a clear picture of how risk the investment, that particular investment or that security is when you have to invest in. So that is the whole show when it comes to risk, return, and their management. So with II, let me bring the II here. We are told to calculate what? We are told to calculate what? Standard deviation. So standard deviation is always denoted as this with this symbol, and you have, remember, this is just a single what? Financial security that we are making an investment, state of economy, depression, and stuff, right? So just a single, let's say a single stock, or let's say a single security that you are investing. When you have two securities that you're investing in, it becomes what a portfolio, right? So that one we'll get to, I think in the B part, you get to that part very soon. So here, when it comes to calculation of standard deviation, this is how the formula also goes. The same thing as the variance, but just the standard deviation, you squared is the square root of what the variance. So you're going to code the same formula So it's going to be n with your summation symbol I is going to be 1, and you have your probability down written here, then you have your 1. Sorry, R, that's returns from different what? Return from different state of the economy, okay? Minus your mean return all what squared. Is that okay? Remember, this is expected data or future data. That's why we're not dividing by what? N. Is that okay? So let's take note of that. But we know that variance was what? 1.37. We know standard deviation is the square root of what? Variance. So once we know the variance will be 1.37, therefore we can say that standard deviation for this investment is going to be the square root of the variance, is what? 1.37. So in that light, let's see with our calculator. What is the square root of 1.37? Gonna give us what? 1.170. So let's say 1.2 decimal place 1.17. So let's take note of that. So going to be 1.17. I hope that is clear. So it becomes what? Your standard deviation. And you can convert this one to percentage by saying that it is 117%. And multiply by 100, you're going to get 117%. So let's take note of that's 117%. So you see the risk factor associated with this investment, and looking at the returns on this investment, can clearly see that this form of investment is a risky investment and the return is very small. But all things we will expect that at the time you invest in any financial security, we are saying that the higher the risk, the higher your return should be. But here is the case that we are having a higher risk, but then a lesser returns. So if anybody should undertake this form of an investment, then we can say that such person is what? A risk lover. For him, love to take more risk as compared to the returns going on to undertake. So if you are asked to go to invest in this form of what? State of the economy to earn, we entrust or we entreat you that this shouldn't be a good decision for you to take, because as you invest, you're going to have huge risks associated with this investment, but then your return is going to be low. So this form of investment shouldn't be a good one for any person seeking to maximize returns in the future to invest, right? For all things being equal, investment, you're saying that the higher the risk, the higher the return should be, and not the other way around. So if the returns are small, but then the risk is high, then it's not a good investment, or it's not a good financial security that you can invest. So let's take note of. So we can clearly see that this form of investment within the state of the economy is not a good one, and so therefore you shouldn't invest. So let's take note of that. Okay, so let's move on to the B part. I hope everything is okay. So if you are really enjoying this video, as usual, please go ahead to smash the like button on this video. Okay, smash the like button, share with your friends, and comment as well. If you are just joining us, you're welcome once again. If you haven't subscribed to the channel, please subscribe to the channel. So by this way, once we go live or release any new video, you'll be the first person to get notified on your device. Thank you once again for being with us at this time. We are grateful having you here. So let's continue with the B part. So with the B part that I read earlier on, so let's start some parameters here so that we go along to calculate what is expected of us. So we are required to calculate the portfolio expected return. Suppose you invest 60% of your portfolio. So when we're talking about portfolio, we're talking about the blend or the combination of what? Securities, with the aim of maximizing returns and reduce what? Risk. Portfolio, we are talking about the blending or combination of what? Various financial securities that you want to invest with the aim of reducing risk and maximizing what? Return. So in that, you're gonna hear the word diversification. So portfolio help us to diversify what? Risk by reducing risk and maximize what? Returns. So that's portfolio, talking about the blending or the combination of what? Financial securities that will yield a good return and reduce what? and reduce what a risk associated with these returns. I hope that's a portfolio. You're talking about the combination or blending of what financial securities that you invest that will yield a good return and reduce what risk. In that, we call it diversification of what risk. So when it comes to risk factor, we have two forms. We have systematic risk and non-systematic risk. Systematic risks are those risks that you cannot avoid. It's called a market risk. It's called unavoidable risk. It is a risk that you can't do anything about it. It's uncontrollable risk or unavoidable risk. But with unsystematic, it's a risk that you can actually do something about. You can control. It's related to a particular or specific jurisdiction. Let's say to the business, right? And it can be avoided. You can avoid it. So either you call unsystematic risk, avoidable risk, specific risk, or diversifiable risk. Okay, so with unsystematic risk, that is what most investors will go into in the form of their investment so that they can easily diversify risk. But with systematic risk, you can't do anything about it. So when there is a general increase, when there is a general price increase in goods and services, you can't do anything about it. Alright? When there is an increase in exchange rate, it is a market price, you can't do anything about it. These are what we call systematic risk. But on systematic risk, you can do something about it. This is just by the way to explain things for you to understand. So now, you suppose you invest 60% of your portfolio in ExxonMobil and then 40% in Coca-Cola. So this is the proportion of your investment, or how you distribute your resource or your money to invest in Mobil and then Coca-Cola. This is how you have distributed it. 60% goes into Mobil and then 40% goes into Coca-Cola. And then it keeps on telling us that the expected dollar return on your ExxonMobil stock is 10%, right? And then Coca-Cola is what? So here we have been giving our returns from these various investments that you have undertaken. That is in the Mobil and then Coca-Cola. You have been giving the returns that with Mobil you get 10% and Coca-Cola your expected return is 15%. It keeps on telling us that the standard deviation of the annualized daily returns are 18.2% and 27.3%. So it means that you have also been calculated or given our standard deviation for this investment, the risk associated with this investment that you are undertaking. And then it goes on to tell us that the correlation coefficient is 1. So correlation coefficient is 1. So assuming a correlation coefficient of 1, then you are required to calculate 1, the portfolio expected returns, II, the portfolio variance, and III, the portfolio standard deviation. You realize that the first one, the A part, was just a single stock, but here is a 2 stock. So that's what we call a portfolio. So most of the time we can invest in different more than 2 stocks. But then normally, for the ease of explanation for people to understand how the investment works in real world, we use 2 stocks or use two forms of investment to help explain the concept when it comes to risk, return, and then portfolio management. I've indicated portfolio management. We are talking about the combination of blending of 4 stocks that will yield a maximum returns and reduce risk with the aim of diversifying risk. So portfolio, once you create a stocks of portfolio, your goal is to maximize return and reduce risk. So let's take note of that. So now, how do you calculate portfolio expected return? This is a formula in calculating portfolio expected return. We call it as RP. R is subscript P. So R is subscript P. So that is I. So return on portfolio is going to be the proportion of your investment in one company. So I'll call it the first company that you invest was the Mobil. So I'll call it as M, right? ExxonMobil. Multiplying the returns gonna end from that company. So Mobil company, right? So it's going to be return, that is individual return on Mobil, right? Plus then you go for another proportion of your investment that you made. That was here in this case was in Coca-Cola. So it's going to be the proportion of the investment that you made in Coca-Cola, that's C, multiplying the returns, we're going to end from Coca-Cola, which is what? C in that case. So this is how we calculate portfolio expected returns. Portfolio, this is a formula for calculating portfolio expected returns. It's very simple. So it's always the proportion of your investment in that company, right, multiplying the return going to end plus the other proportion that you invest in the other company plus multiplying the returns you're going to end from that. So it's actually a proportion that you invest. The proportion of your money that you invest in the company, multiplying its returns, and the percentage proportion of. So most of the time it can be in percentage, or it can be in percentage or in decimals, or it can be even real amount of money. So if you don't give you percentage, you're going to see decimal. You're going to also see it as an amount of money. That you can use it. So before you're going to see this, just apply them. That returns on portfolio is going to be the proportion of the investment that you made in one company, multiplying the returns going to end from that company, plus the other proportion of the investment made in the other company, multiplying the returns going to end. So assuming that you actually invest all your resources in one company, it cannot be a portfolio. It will be just a single stock, right? But then if you spread your investment across different investment security, that's where we say that you are creating a portfolio of investment. The aim here, or the goal here, is to maximize your returns and then to diversify risk. So in this case, if let's say one investment that you made even didn't go well, at least the other one can also sustain you. So when you spread your investment, it's good. So any investor who spread out his resource in different form of investment, financial securities, is a good way of that person reducing, or that investor reducing its risk and then maximizing returns. So that is the goal here. So here, all that we need to do is to do a substitution. Remember, the investment percentage that you invested in mobile was 60%, so it's going to be 0.6, right? Multiplying the returns, if we said the return was 10%, it's going to it's going to be 0.1 plus. So let's go for the proportion also you invest in Coca-Cola. In percentage was 40, so it's going to be 0.4. Multiplying the returns, you're going to end, that was 15%. So 0.15. I hope that is clear. So with the calculator, we should be able to arrive at an answer. So let's see. 0.1 multiplying 0.6, okay, plus 0.4 multiplying 0.15. You arrive at 0.12. That is 0.12. I hope that is clear. 0.12. So here you're going to get 0.12, or you're going to get 12%. So there's a return you earned from your investment. When you spread your investment across various financial securities, you're going to earn as a return on the portfolio that you have created for yourself as an investor. I hope that's good. This is how we calculate the expected returns. If there is any question, let me see in the comment section so that I can respond to it. In that case, make sure to like this. If you haven't liked, make sure to like this video, share with your friends, and subscribe, so that by this way we go live or release any new video, you'll be the first person to get notified. Thank you. So this is our return on the portfolio that you have invested. Actually, the resource that you have invested in these financial securities, that's stock in Coca-Cola and the mobile in that case. So let's take note of that. All right, so let's continue with II. We are asked to calculate the portfolio variance. So when it comes to portfolio variance, okay, it's actually, as I've explained where I was explaining the single stock investment that we were making here, it's the same thing, but just that it consists of two investment security that you are making an investment in, right? It consists of two financial securities that you are making an investment in. So the same rule, variance help us to know the risk associated with the risk, but doesn't give a good picture. But then standard deviation will help us to know a clear picture of the risk factor associated with, in this case, associated with this portfolio that you are making. So you're gonna follow the same format, but then when it comes to portfolio, the variance formula changes slightly. This is how we calculate the portfolio variance. It is always the proportion of your investment in one company. So first one, the mobile company, right? You squared it, right? And then multiply by the square of your standard deviation, right, from the other company. I mean the first company you invest, right? You squared it. So let's do it in this way that I get to appreciate what I'm saying. So it's going to be multiplying, I'm gonna have it like this. Is that okay? So that's going to be for M, plus goes on to the next company, that was for Coca-Cola. So proportion of your investment multiplied by the standard deviation from the Coca-Cola investment you're making, which is what? So that one you're going to square it to come in. So you square this, you also square this, right? Plus, so here it's gonna be 2 multiplying the proportion of your investment in Coca-Cola, multiplying your proportion of investment in mobile, multiplying your investment proportion in the Coca-Cola, multiplying your standard deviation in mobile, then your standard deviation in Coca-Cola, then all multiplying your correlation coefficient of mobile and then Coca-Cola. So this is a formula when it comes to portfolio, but it's very simple. Once you have this, you can easily do your substitution. And in this question, we have already been giving out these elements, so you can just, it's a matter of substitution. So it is a proportion of your investment in one company squared it, and then it's standard deviation squared, plus the proportion of the other part of your investment squared, and it's what? Standard deviation squared, plus twice of the proportion of your investment in one company and the other, and their standard deviations, all multiplying the correlation coefficient, which is what here in this case was 2, so mobile and then that of Coca-Cola. And that's what they make us aware that let's assume that correlation coefficient of what? 1. So that's what we're going to substitute in this case. So in this case, let me bring it here. I can say that let's see the proportion of my investment in the mobile. So it was 60%, but that is W. So we're going to represent what? 60%. So we're going to be 0.6 squared, right? Multiplying, so our standard deviation was also given. The standard deviation of the annualized returns was 18.2% and 27.3%. So here we're going to convert them to decimal. So it's going to be 0.183 squared as standard deviation, right? Plus, then you go for Coca-Cola. Coca-Cola owns to, the proportion was what? 40%. So it's going to be 0.4 squared multiplying the standard deviation, which was what? 27.3%. It's going to be 0.273 all squared, plus when it comes to twice of the proportion of our investment in mobile is 0.6, right? And then that of Coca-Cola is 0.4. Okay, multiplying. So let me bring it here. Remember, it's multiplying, right? So I'm bringing it here, just here, multiplying our standard deviation for mobile was what? Standard deviation was 0. So it's going to be 0.183. all right? and then multiplying another standard deviation calculator, which was what, 0.273. okay, and then multiply by your correlation coefficient of 1. I hope that's clear. So with this long list, with your calculator, just punch it once and then you are good to go. So let's see what our calculator is going to give us with this variance. So that we clear it off. So with my calculator, I had here to be, the summation of all, I had 0.047961. So this becomes the portfolio variance. This becomes the portfolio variance. So for you to get the portfolio standard deviation, we said standard deviation is a square root of variance. So it's going to be, that one's going to be, so here that is II. So let me have the II here. I that standard deviation is going to be the square root of the variance. So the square root of 0.047961. So let's take, so we come here, square root of 0.0474961, going to give us 0.219. So let's say 0.047961. So we get what, 0.219. So that becomes the square root of that. So in that will going to give me my standard deviation or portfolio standard deviation of that, which is what, 0.219. So if you want to convert to percentage, it's going to be 21.9%. 29.9%. So you realize that here, the higher your returns on portfolio, the higher also with your risk. So likewise here to here, the risk was too far outweighing your returns. Here you see that the returns was 70%, right? That was good. But here you see the risk factor 2 was also what, 117%. So here in risk and return approach, you are saying that the higher the returns, the higher our risk. So always you need to make a better decision and to ensure that your decision will maximize your returns and diversify or reduce your risk in that case. So this becomes the risk for this portfolio, its variance, which is this standard deviation, and then the portfolio was expected returns in that case. So that is that for all of these two questions. So if this video was really helpful to you, please go ahead to smash the like button, subscribe to the channel, like and share. Subscribe to the channel, please like and share. Please like and like this video, very important. So guys, thank you once again. I will see you in the next session. I wish you the very best in your exams too. Make sure to write well, and then with this you're able to pass and excel in your examination. I will see you. Bye bye.